Hi everyone, I'm Maggie McGrath, the editor of ForbesWomen. We are here at NASDAQ Market Site with Amy Nauoikas. She is the founder and CEO of Anthemis. Amy, thank you so much for being here.
Thank you so much for having me.
You started investing in FinTech in 2008, probably before most other investors. And I just want to read you a few statistics about where we are right now. So funding for FinTech startups was $141 billion in 2021. That dropped to $75 billion in 2022. $39 billion in 2023. What is the state of funding for FinTech in 2024?
Well, it's been, as you can imagine, a very intense and in some cases bizarre couple of years. I have to say from our perspective, we've been at this for quite some time. The market needed to cool down, and I think sort of the last, certainly 2022 to end of last year, that cool down was incredibly warranted, right? There's two things that cause problems in a venture market. When a founder thinks their company is worth a certain amount and when somebody pays them for that. and if they're not aligned, then it can create froth and all sorts of problems. And I think the good news is we got rid of a lot of the sort of folks coming into the market that maybe didn't belong there from an investor perspective. A lot of us who are currently and actively investing in the VC community have been here for a very long time, and I think for FinTech in particular, that's really important because this is not a market that is sort of open to everyone, right? You have to really understand the market dynamics, you have to understand the regulatory framework that we're living in to be able to properly invest in FinTech companies, and I really do think we needed some of the folks that were sort of coming along and giving it a whirl to disappear. Sorry.
Giving it a whirl with FinTech. Talk about the market conditions, talk about the regulatory environment. We're in an election year.
Yeah.
What are the 3 or 4 factors you find yourself thinking about the most these days?
Yeah, well, so we're early stage investors, and largely all of our work is in the early stage. And so that makes it sort of easier to not think about this year or next year, but really we're looking at kind of a 10-year cycle. We have been one of the earliest investors from a thesis perspective focused on embedded finance, the idea that finance is and should be ubiquitous inside of our economy, and the health of our economic system in large part relies on the health of that financial system. And so when we look sort of 5-10 years out, we continue to think about how do we find the infrastructure opportunities that will fuel the entire system, and in the best case scenario, become invisible. And those are the often less sexy trades in the market, but they're the ones that can yield the highest return. And also it requires having a insider's mindset in terms of how the markets work, but also recognizing that the ideas can come from anywhere.
So you've invested in companies like Betterment and eToro, among many, many others, but I think those are 2 of the more well-known companies in your portfolio. And one of the things that we were talking about before we got on set is the term FinTech outdated? Because I don't personally interact with finance without technology.
Right.
It's almost all on my phone, all on my computer. Yeah. I do very, very little with a pen and paper. And when you started in 2008, the idea of embedding technology into finance was a little more novel. So are all finance companies FinTech companies?
Well, remember, I started investing in 2008, but before that, I was in what has now become the FinTech community since the mid to late 90s. And I think that is what people sort of have forgotten, right? That our job as investors in financial services technology should be to put ourselves out of business, right? If the digital revolution takes full hold and the rails of our financial system become invisible, then we win. We all win, right? Because it means that it's working more equitably, it means it's working more transparently, and it means there's more access. And that's what we optimize for at Anthemis all the time. I will say though that when we first started, it's kind of it's music to my ears to hear you say that is FinTech obsolete. When we started, we used to talk about. I remember going out early days to investors and trying to get them to back us and talking about how we believe the digital revolution of financial services, where we could create invisible rails in the financial, and people would just glaze over. And so at a certain point around 2014, 15, we're like, oh, just call it FinTech. That's what everybody else is calling it. We cannot be any, this is one where we don't want to look any different than anybody else, and so let's go for it. But it is going away. I think people are recognizing that you can't have financial services without technology, and you certainly can't have an economy without a healthy financial system.
It's interesting that you talk about invisibility being a good thing, because you alluded to there being transparency there, but I hear invisible and I think less transparency.
Yeah.
How do you square that?
Well, I think it's about, and I've been thinking a lot lately about the idea of friction and what does friction mean inside of an economy that has been largely digitized. And for me, I feel there's a certain responsibility to recognize that just because something is invisible or works really well doesn't mean that we don't want to optimize for putting the right types of friction into that business model. And I think that there's, when we look at our thesis, I think there's a longer term plan to bringing some of the friction we've maybe optimized out of the system back in and replacing some of the kind of, the infrastructure stuff that just works better with that human element again, which I think we're missing.
What's a practical example of the right balance of friction and frictionless?
I don't know if this is the right example, but I think when I think about Uber, it's a perfect example. It is ultimately a payments company, and the reason why Uber works and has worked so well for all of us is not because their cars are particularly better, the drivers are particularly better, but because now we can schedule and or pay for them on a phone, and that is finance. That's FinTech, right? That's what that is. But when you walk into an Uber every morning, you don't say hello to the person. They don't say hello back to you. You're making a contract with that person and they get paid and you get where you need to go, but you're putting yourself in that particular moment, whether it's a 5-minute drive or an hour drive, in the hands of another human being in a car, a motor vehicle. And I think we need to start thinking a little bit more about what that means, right? Is there a way for us to continue to behave as humans in this society without still using the efficiency of technology and the transparency and the access that it gives us, but doing it in a way that brings some of that human friction back in?
So as you're looking for new investment opportunities, is that happy medium balance of friction one of the aspects that you're looking for in new businesses?
I think so. I think one of the things that I've been trying to figure out is, when it comes to AI, for example, everybody and their brother is talking about AI in every industry. We kind of joke that now if you send us a business model, just sort of take out crypto and insert AI here, and it's the same business, just different words. And so we're being very careful about the AI businesses that we're looking at. No doubt that AI will have a massive impact on the landscape of business and the landscape of financial services for sure. I think it's still early to kind of call it. And so when you look at a business model that inherently has AI at its core, a big part of what we look at from an early stage perspective is who are the people deploying this AI? What is that founding team like? What do they care about? What are their values? Why do they create this company? Because at the end of the day, it's the people who are creating the AI. It's not being created in a vacuum.
Talking about not creating technology in a vacuum and having diverse and inclusive perspectives, I know you have paid attention to diversity and inclusion as you have made investments over the years. And we're in an environment now where DE&I is under attack. How do you navigate this environment where diversity is in some corners of the internet becoming a dirty word?
Yeah, Maggie, it is. I wish I had the answer. It is so hard, and it can be at times exasperating. I personally started Anthemis, not in large part exclusively because I wanted to do something that made a difference inside of financial services, and this is what I could do. And from day one, we put DEI at the top of our list. It was before there was an ESG moniker or even an impact rule of thumb, and it was just good business, and it was the right thing to do. And without trying, we talk about it being sort of organic diversity, without trying, we have a team that is always just around the 50% gender diversity mark. 65% of our investment team are women, and the leadership across our IC are women as well. And what I do know for certain is that when we look at business and potential trades, we're looking at looking in very different ponds. Like there is nobody else out there scoping the FinTech world the same way we are. And that has a lot to do with who we are as a team. So if we can do it in one of the most non-diverse communities out there, anybody can do it. And it is our responsibility to do it. But it starts with putting your own mask on. You have to make sure that your team is diverse, and I guarantee you it's going to change the type of transactions you see, because my team swims in different ponds than everybody else. They just do. And their communities are different. And that's how we get the best deal flow, I think, the best deal flow in the industry.
Your perspective is one that's been achieved through your own experience. You started your career in the Peace Corps. How do you go from the Peace Corps to running a VC firm, and maybe more specifically to what we were just talking about? How does that fuel your perspective as you're building your firm, as you're sourcing investment opportunities?
Yeah, I mean, it certainly it influences everything. You know, I mean, everybody's background is kind of where they come from. And for me, I grew up 100% feeling like an outsider in the community that I grew up in. Socioeconomically, I was not of the same community, and that was hard. And I knew what it felt like to be the other. And so as I traveled through life, I had just in my mind's eye a kind of a foregone conclusion that others mattered. And yeah, I think that's kind of where it started. I think the Peace Corps was an interesting experience for me because I went and spent my time in sub-Saharan Africa and Cameroon, and part of being the other there was incredibly educational, because I hadn't had an experience around race that had ever lived in my life as living in a white body, and that was extraordinary for me. And I think I just knew when I came back that I didn't want to do anything that didn't involve all. And I think we get really, really quick in our world to keep ourselves focused just on our kind of immediate, and a lot of times those communities aren't diverse. And we have to work a little harder if you want to include all.
You are someone who's focused on diversity, as we've just been discussing. Sometimes I feel like these conversations happen in a bubble. I have a lot of these conversations. Women's spaces have a lot of these conversations. How do we have more of these conversations in the communities that need to hear them?
Yeah, that's a great question. I have been thinking a lot lately about my own role as a sort of 50-something woman in financial services who spent my entire career here. And I have been thinking a lot about the generation of people that came before me and what my role is to honor them. Because I think, if you think about sort of 80s Wall Street, that was a really tough time to be a woman on Wall Street. And I think the more I recognize why I didn't have any mentors and why I didn't have anybody fighting for me, I get it now. And I don't think I got it as much then when I was younger. And so I've been spending a lot of time now honoring that community and thanking them, frankly, which I think all generations should do. Only on other people's shoulders do we stand. And I think that's a big part about this conversation, because it's going to get really hard in the next couple of years, like really hard. And if we're not collectively as women supporting other women, I don't think we're going to win. And I don't think we're going to make the progress we need to make. And so I guess the one thing I would encourage everyone to do is to recognize the people that have fought the good fight so that you can exist, and to recognize how important that is as you're giving back and leaning in.
When you say it's going to get hard in the next couple of years, in what respect do you think?
Yeah, look, I have to wake up every day optimistic that the work that we're doing at Anthemis is making a difference. And I do believe that the conversation around DEI, the conversations around investing in the financial system to make the world a better place, we've played a huge role in that. I don't know that everybody believes that's why one should be a VC investor, but it's what we believe. It's what I believe. I think that it's becoming lonelier and lonelier now that we're seeing how many people use DEI simply as an opportunity virtue signal. And there were a lot of conversations happening in 2020. It's that moment between 2020 and 2022, it felt like we might actually do something. We might actually make a difference. And it got really easy really fast when the markets got tough to pull away from things that actually do have a positive impact on the economy and a positive impact on business. But I feel like the only way to keep it going is for all of us to sort of collectively agree that we're going to. And it's going to be hard, because I think there are going to be lots of systemic issues against us, calling for different approaches, and they're not going to necessarily focus on the approaches that are important around supporting gender equity inside of VC, business, financial services, everywhere.
So with respect to diversity, equity, and inclusion, the next few years look challenging, but with respect to the FinTech fundraising environment, you're a little more optimistic.
I am.
And I asked you about what entrepreneurs are asking you these days, and you said, I think people really want to know that when we say it's going to get better, that we mean it.
That we mean it, and we put our money where our mouth is, right? I think that there was a natural cooling off of the industry that was well needed. But now those of us who have capital to deploy and who know this industry and who've been here from the beginning, we need to be starting to invest, and we can't be alone in it, right? We need to partner, we need to collaborate, and we need to start this market up again. I think there's huge opportunity for the future and massive opportunities for some of the companies that we're seeing in the pipeline. But if we don't start and put our money where our mouth is, then I don't know how it gets started. I mean, I think this is a great moment for FinTech companies, but it's a great moment for VC. Any true value creation in VC in the past, call it 50 years, is always higher valuations and higher return and higher success rates when you're in a really down market. And this down hit that we've had has been well positioned to allow us all to kind of question why we're here.
And it's forced you to do more with less, which ultimately makes you a better investor.
Absolutely, and we've always had, and there's a lot of attention right now given to smaller funds, and I think I wouldn't want to be sitting on 600 million plus in early stage capital to deploy right now for a vintage 2024 fund. For us, it's always been quite easy because we've kept our fund sizes small, and I think that's going to continue to be a trend. It makes you a more conscious investor, and I think it helps to be capital constrained because it forces the choice mechanism. You don't have obscene money to just put everywhere. You have to actually make conscious choices, and you have to decide. And I think from a portfolio construct perspective, that is a much better and smarter way to invest in the early stage. And we've been consistent with that from the beginning.
So DEI will get tricky, funding environment will get better, the idea of too little friction keeps you up at night. Any final thoughts, trends, or predictions you have to share with our Forbes audience?
Well, oh gosh, I guess I just, to anybody that's sort of out in the VC community right now, a founder that's trying to start a company, I would just encourage everyone to just keep at it. I think, anytime there's a disruption in a market, it can throw people into a bit of a tailspin, and you see a lot of people leave. Hopefully the right folks have left, but if you have a good idea and you believe in what you're doing and you really believe it can make a difference, there will be funding for you out there. Do not give up. You will find your path, and we need more entrepreneurs like you.
Amy Nauoikas, thank you so much for joining us at our studio at the NASDAQ Market Site. We so appreciate your time and insights.
Thank you, Maggie.